All right, everybody, welcome back to Mike Norman Economics. Well, I've been getting a lot of mail from all of you, and many of you have been asking or saying, okay, well, Mike, fine. We understand maybe that the Fed is not actually printing money, and maybe it is just an electronic entry, a keystroke on a computer keyboard, but still, that's still money in the system. When they buy securities, it adds to reserves and they are creating new money. And I say it's still wrong. Those are reserves. And just from point of fact of definition, reserves are not part of the money supply, nor are reserves spent. That's why they're called reserves, okay? Now, the addition of reserves to the banking system in conjunction with the Fed attempting to bring down the interest rate may, the banks could use additional reserves for lending purposes. However, they're not obligated to. And we see this happening right now. This is part of the problem, that in the last year, although the Fed has increased reserves by 800 or 900 billion, we have actually seen total bank credit in the United States drop by about 200 billion. So the reserves are not being used for additional lending. Now, the important thing here, though, is something that I'm going to tell you, which you're probably going to find quite fascinating. That loans that banks make create their own reserves. So reserves are not necessary in and of themselves for banks to make loans. A bank will make a loan because it sees a business opportunity. It is in business to make loans. That's how it makes a profit. It is in business to make a profit. And if it sees an opportunity to make a loan with a worthy borrower, it'll do it, whether or not it has the reserves. Now, here's what happens. Let's say a bank has no excess reserves. All of its reserves are spoken for in terms of the amount of money now that it is lent out. But it sees an opportunity to make a new loan, let's say for $1,000. It makes the loan for $1,000, but now it needs $100, use that 10 to 1 or 1 to 10 ratio, it needs $100 in new reserves. So the bank is short reserves. The moment it makes the loan for $1,000 and it creates a new checking account for the borrower, it is now short $100 of reserves, which creates an overdraft in its reserve account at the Federal Reserve. And the Fed automatically credits the bank with those reserves. So the reserves were created with the loan. So therefore, it is sort of irrelevant whether there are 800 billion of reserves, new reserves in the system, or if we were back to where we were last September of 2008 with only 7 or 8 billion of reserves. It does not constrain the bank in any way from making the loans, and when they make the loans, boom, the reserves are automatically created. So again, reserves are not spent, and just because the Fed provides reserves as part of its goal to bring interest rates down, that does not mean by the same token that automatically it's going to create new lending, which will result in new spending. So this automatic assumption or this claim that we hear all the time that the Fed is printing money, well, now you know they're not printing money. And those of you who are a little bit more savvy, who've been conceding that point and saying, okay, well, we know they're not printing it, Mike, but they're creating new money. Well, they're not. They are not. Most of what we call money is created in the banking system, and that is done independent of whether or not the Fed desires to put reserves in to bring an interest rate to a certain level. Lending occurred back in 1980, 81 when interest rates were 21%. Lending is occurring now, although at a very much slower rate. And we have seen a very huge increase in reserves and actually a contraction in total bank credit. So this idea that the Fed is printing money, it is absolutely, absolutely not true. I think some of you are starting to understand it, but this concept, and by the way, I want to thank Warren Mosler and Scott Fulwiler, two great, great economists. And you could go to Warren's site at moslereconomics.com. He's also running for president in 2012. He's definitely going to get my vote. And Scott Fulwiler, also a great economist and contributes quite often, comments on my blog. Thanks to both of you guys for explaining that overdraft situation and how loans create reserves. Well, that's it for now. As usual, I welcome the comments, so let's hear from you, and we'll be seeing you next time. Take care. Bye.